The impact of inflation on retirement savings is one of the most important topics every American over 50 needs to understand clearly right now. If you depend on retirement accounts, collect monthly Social Security benefits, receive a pension, or still carry a mortgage on your home, taking steps to protect your purchasing power over the next decade can make a real difference in your quality of life. Many people have worked hard for decades, followed traditional financial advice, and built what they believe is a secure retirement. But changing economic conditions, especially around government debt levels and inflation, can quietly affect even the most carefully planned portfolios. A similar situation played out in American history after World War II, and reviewing what happened then can offer useful lessons for today without any guarantees about the future. Between 1946 and 1974, the United States faced very high federal debt following the war. Debt reached roughly 121% of gross domestic product. Policymakers at the time chose to manage this burden partly by keeping interest rates paid on savings accounts and government bonds below the actual rate of inflation for extended periods. This policy approach, historically referred to as financial repression, gradually reduced the real value of outstanding debt. Savers experienced a slow decline in purchasing power, while borrowers with fixed-rate loans often saw the real burden of their debt decrease as inflation rose. This was not a sudden event or market crash. It was a long, gradual process that lasted nearly 3 decades. During that time, people who kept large amounts in safe, conservative accounts often watched their money buy less and less, even as the nominal balance grew slightly. At the same time, the government's debt-to-GDP ratio fell significantly without needing massive budget surpluses every year. Understanding this history helps today's retirees think carefully about how they position their savings, bonds, and debts. It is important to be clear that no one can predict exactly what policies will be implemented or how inflation will behave in the coming years. Economic conditions depend on many factors, including government spending, Federal Reserve decisions, global events, and productivity growth. However, learning from past periods when inflation outpaced returns on traditional safe investments can help you ask better questions and make more informed choices with the help of qualified professionals. Retirees today face unique challenges because many are living longer. Healthcare costs continue to rise faster than general inflation, and the cost of everyday essentials like food, housing, and transportation can add pressure to fixed budgets. Taking time to understand these dynamics allows you to build a more resilient plan that supports your lifestyle for the long term. It is also wise to consider how your spending habits might evolve. Many retirees find that travel, hobbies, and family visits become bigger parts of their budget, so planning for flexibility in those areas can prevent stress later on. Let's look at some typical examples that reflect what millions of Americans are experiencing. These stories are based on common patterns and are meant to illustrate important principles rather than predict individual outcomes. First, consider the cash saver. Many retirees, especially after losing a spouse or selling a property, keep substantial emergency funds in federally insured savings accounts or certificates of deposit. These options feel secure because they are protected by the FDIC and usually provide steady, modest interest. However, when inflation runs higher than the interest rate you earn, your money can lose purchasing power over time. For older Americans, this effect can be stronger. The Bureau of Labor Statistics calculates a separate consumer price index for elderly Americans that gives more weight to medical care and housing costs. In recent years, this measure has often run higher than the general CPI. A retiree earning 4% on savings while facing 5.5% to 6% effective inflation for their spending needs could see a real annual loss, even if the account statement shows a small gain. Over 10 years, these small annual gaps can add up to a meaningful reduction in what your savings can actually buy for groceries, healthcare, utilities, and daily living. This is why many people are now looking for ways to keep some cash accessible for emergencies while moving other portions toward options that better maintain value when prices rise. Keeping 3 to 6 months of essential expenses in liquid savings is still recommended for peace of mind, but anything beyond that might benefit from a more balanced approach. Second, the mortgage accelerator. Some retirees with low-interest fixed-rate mortgages have been making extra principal payments to eliminate debt as quickly as possible. This strategy made excellent sense in low inflation or deflationary environments. But in periods where inflation stays moderately elevated, a low fixed-rate mortgage can actually work in the borrower's favor. For example, if you hold a mortgage at 3 to 4% and inflation averages 5% or more over time, the real value of the remaining principal decreases gradually. Every extra dollar paid beyond the minimum required payment reduces this natural advantage and moves cash from your pocket into paying down debt faster than necessary. Many financial professionals now suggest that in certain inflation environments, it can be smarter to make only the contractual minimum payments and redirect the extra money toward assets that may help offset rising costs. Of course, this only makes sense if your budget is comfortable, you maintain good credit, and you have other savings for unexpected repairs or life events. Always review your specific loan terms and run the numbers carefully with an advisor who knows your full financial picture. Refinancing options or home equity strategies could also come into play depending on your situation and current market rates. Third, the conservative bondholder. For decades, long-term treasury bonds and high-quality bond funds were considered ideal for retirees who wanted to preserve capital. They performed very well when interest rates were falling from the 1980s through the 2010s. However, in environments where inflation is persistent and interest rates are managed to stay relatively low, long-duration fixed-income investments can face challenges. The purchasing power of the interest payments declines, and if rates rise, the market value of existing bonds can drop if you need to sell before maturity. This does not mean all bonds are bad. Short-duration bonds and inflation-protected securities serve different roles. The key is matching your investments to the economic reality you actually face, rather than repeating strategies that worked in completely different decades. Many retirees are now reviewing their bond holdings to see how much is locked in fixed rates that may not keep pace with their actual living expenses over the next 10 to 15 years. Laddering bonds with different maturity dates can also help provide steady income while reducing reinvestment risk. Here are 4 straightforward actions many retirees are reviewing with their advisors right now. These are general ideas for educational purposes. Always consult a licensed financial advisor and tax professional before making changes to your specific portfolio. First, complete a clear audit of your fixed income holdings. Take 30 minutes to gather your latest statements from banks, brokerages, and retirement accounts. Add up the total amounts in regular savings accounts, certificates of deposit, money market funds, short-term treasury notes, longer-term treasury bonds, corporate bonds, and bond mutual funds or ETFs. For many retirees, fixed income investments still make up 60 to 80% or more of their total savings. Seeing this number in black and white helps you understand your exposure if inflation remains above the yields these accounts provide. This simple exercise costs nothing and gives you a solid starting point for planning. You might discover that what felt conservative on paper is actually more exposed to rising prices than you realized, which opens the door to making small, thoughtful adjustments over time. Second, reevaluate accelerated mortgage payments. If you currently have a fixed-rate mortgage with an interest rate below 5.5%, consider pausing any extra principal payments above the required minimum. Reset to the contractual monthly amount and redirect the difference into other areas. A low fixed-rate mortgage can serve as a form of inflation hedge because you repay the loan with dollars that may be worth less in the future. This approach can free up cash flow that you can use for healthcare, travel, family support, or building inflation-protected savings. At the same time, it is essential to keep your overall debt at a manageable level and avoid stretching your budget too thin. Homeowners should also factor in property taxes, insurance, and maintenance costs, which often rise with inflation, so balancing the mortgage strategy with other protections is important. Third, consider moving portions of your savings into inflation-protected instruments. 2 widely available options backed by the U.S. Treasury are Series 1 savings bonds, often called I bonds, and Treasury inflation-protected securities known as TIPS. I-bonds are easy to purchase directly through treasurydirect.gov. Their interest rate adjusts every 6 months based on the official Consumer Price Index. They also offer tax advantages. The interest is exempt from state and local taxes, and under current rules in Internal Revenue Code Section 135, the interest can be entirely federal tax-free when used for qualified higher education expenses for yourself, your spouse, or dependents. Annual purchase limits apply: $10,000 per person electronically, plus up to $5,000 more in some cases with a tax refund. A married couple can therefore direct up to $30,000 per year into I-bonds. These bonds are particularly attractive for retirees because they are simple, safe, and directly tied to inflation measures. TIPS work differently. They adjust the principal value of the bond semi-annually with inflation. You can buy them in various maturities of 5, 10, or 30 years through Treasury Direct or any brokerage account with no annual purchase limit. Many retirees build a TIPS ladder, buying bonds with staggered maturity dates that match when they expect to need the money. This approach can help provide more predictable real purchasing power and reduce the worry of outliving your savings due to rising costs. A practical sequence for someone with significant cash in CDs might be to first max out I-bond purchases for both spouses, then gradually shift remaining funds into a diversified TIPS ladder. This does not mean moving everything at once. Many people start with 10 to 20% of their fixed income assets and increase over time as they become comfortable. Fourth, check inflation adjustments on all income sources. Social Security includes automatic cost of living adjustments based on the CPI, which helps protect benefits over time. However, many private pensions, corporate retirement plans, and some state or local government pensions do not offer automatic increases. Contact your pension administrator and ask a direct question. Does my monthly benefit receive an annual cost of living adjustment, and if so, which index is used? If your pension has no inflation adjustment, treat it like a fixed income asset that will lose real value over time. You may need to build additional protection in other parts of your portfolio, such as through I-bonds, TIPS, or other assets that historically perform better during moderate inflation periods. Real estate that generates rental income with the ability to adjust rents, or shares in well-managed companies with strong pricing power, are also worth discussing with an advisor. Beyond pensions, think about all your income streams, including part-time work, rental properties, or required minimum distributions from retirement accounts, and how they might hold up against rising prices. For grandparents concerned about rising college costs, the tax treatment of e-bonds can be especially powerful. You can purchase the bonds in your name, hold them while they adjust with inflation, and later redeem them tax-free at the federal level when paying qualified tuition and fees directly to an educational institution. This creates an efficient, inflation-protected way to help the next generation. Combined with the state and local tax exemption that always applies, it is one of the more attractive options available to middle-income households. Planning for education expenses this way can reduce the burden on your children and grandchildren while preserving more of your own retirement security. One mistake many people make during periods of market volatility is panic selling longer-term bonds in a taxable brokerage account when prices fall. This locks in losses and can create unnecessary tax events. A more thoughtful approach is to make changes first inside tax-advantaged accounts like IRAs or 401ks where possible, then handle taxable accounts gradually over multiple years to manage capital gains and losses. Always move proceeds directly into suitable replacement investments rather than letting cash sit idle in low-yielding accounts. Diversification still matters greatly. Even when shifting toward inflation-protected assets, it is wise to spread your money across different maturities, asset types, and risk levels rather than putting everything into one category. Consider your overall asset allocation, including some exposure to stocks of stable companies, real estate investment trusts, or other areas that can grow with the economy. Assets that behave differently in this environment deserve careful attention. More exposed positions often include large cash holdings in ordinary savings, long duration bonds without inflation adjustment, fixed annuities without cost of living adjustments, and pensions with no inflation protection. Better positioned assets frequently discussed include low fixed rate mortgages, I bonds, TIPS, income producing real estate with rent adjustments, and equity investments in companies that can pass on higher costs to customers. Strongly protected income sources include Social Security and any pensions or annuities that have reliable, automatic cost of living adjustments tied to official inflation measures. Building a mix of these can help create balance and reduce worry about any single economic factor. The period ahead will likely reward careful planning rather than dramatic moves. Taking time to open a Treasury Direct account, the process takes about 20 minutes with your Social Security number and bank details, completing your fixed income audit, and speaking with a financial advisor about your specific numbers can put you in a stronger position. Remember that every retiree situation is unique. Factors like your overall health, expected longevity, other income sources, tax bracket, and risk tolerance all matter. This information is for educational purposes only and is not personalized financial advice. Work with licensed professionals who understand your complete picture before implementing any changes. Senior Wellness Hub encourages all retirees to stay informed, remain proactive, and focus on practical strategies that support a comfortable and dignified retirement. Taking responsibility for your financial health today can reduce stress and provide greater peace of mind for the years ahead. Start with the audit this week. Open that Treasury Direct account if you don't have one. Ask the questions about your pension. These small actions add up and demonstrate the kind of thoughtful planning that has helped generations of Americans protect their savings through changing economic times. By staying educated and acting prudently, you give yourself the best opportunity to maintain the lifestyle you worked so hard to achieve. The goal is not to chase unrealistic returns, but to preserve real purchasing power so your retirement dollars continue working effectively for you and your loved ones. This approach, combining historical awareness, practical tools like I bonds and TIPS, careful mortgage management, and regular reviews, forms a balanced framework that many retirees are adopting successfully. There are no magic solutions, but informed, steady action remains one of the most reliable paths forward. In addition to these financial steps, think about the broader picture of wellness in retirement. Maintaining physical health through regular exercise, nutritious meals, and routine medical checkups can help control healthcare expenses that often rise with age. Building strong social connections with family and friends provides emotional support and can even lead to shared resources or advice on managing costs. Many retirees also find purpose through volunteering, part-time consulting, or pursuing hobbies that keep the mind active and may generate small supplemental income. Another area worth exploring is long-term care planning. Whether through insurance policies, dedicated savings, or family discussions, preparing for potential future needs can prevent a sudden drain on retirement assets. Reviewing your estate plan, updating beneficiaries, and considering strategies for required minimum distributions from retirement accounts are also valuable steps that tie into inflation protection. Taxes play a big role too. Understanding how different income sources are taxed and using tax-efficient withdrawal strategies can stretch your savings further. For instance, withdrawing from taxable accounts first in some cases, or coordinating Social Security claiming age with other income can optimize your overall plan. The coming weeks and months offer a window to review these ideas while current opportunities on inflation-protected securities remain relatively accessible. Delaying indefinitely can mean missing the chance to lock in protection at today's terms. Small, consistent adjustments made with good information often lead to better long-term outcomes than waiting for perfect clarity that may never arrive. If you found this discussion helpful, consider sharing it with a friend or family member who is also navigating retirement planning. Many people in their 60s and 70s are quietly worried about rising costs, but unsure where to start. A simple conversation can help others take constructive steps. Ultimately, retirement success comes from preparation, flexibility, and a willingness to learn and adjust as conditions change. By focusing on preserving purchasing power, managing debt wisely, and using safe government backed tools, you can face the future with greater confidence. Senior Wellness Hub is committed to providing clear, practical information that empowers older Americans to live healthier, more secure lives. Take one step today, review your statements, make a call, or schedule that advisor meeting. These actions build momentum and create a stronger foundation for the years ahead. Your future self will thank you for the thoughtful effort you put in now.